You work hard, you save diligently, you compare mortgage rates, you contribute to your retirement account, you try to make smart decisions for your family. And yet, somehow, the cost of borrowing money changes. Mortgage payments rise, retirement balances fall, companies stop hiring, layoffs increase. Most people assume those changes are caused by banks, politicians, or the Federal Reserve. But there is another force at work, a force so large that it quietly influences almost every financial decision made in America. And the fascinating part, most people have never spent even 5 minutes learning how it works. Today, I want to change that, because once you understand this market, you'll never look at your mortgage, your retirement account, or your savings the same way again. I'm talking about the bond market. Now, before your eyes glaze over, stay with me. I know bonds don't sound exciting. They sound like something your grandfather owned. They sound like something financial advisors bring up right before everyone starts checking their phones. But the truth is that bonds are one of the most important financial instruments ever created. And understanding them could save you tens of thousands, sometimes hundreds of thousands of dollars over your lifetime. Let's start with something surprisingly simple. At its core, a bond is nothing more than a loan. That's it. A government needs money. A company needs money. A city needs money. Instead of borrowing from a bank, they borrow directly from investors. You lend them money today. In return, they agree to pay you interest and eventually return your original investment. That's the entire deal. No mystery, no magic, no secret Wall Street formula. Imagine lending a friend $1,000. Your friend promises to pay you $50 every year for 10 years and then return your original $1,000 at the end. Congratulations, you've essentially created a bond. Now imagine doing that not with your friend, but with the United States government, or a major corporation, or your local municipality. That's how the bond market works. Simple idea, massive scale. And when I say massive, I mean massive. The global bond market is estimated to be worth well over $140 trillion. Think about that number for a moment. We talk about stock markets all the time. Financial television talks about stocks all day long. Social media influencers obsess over stocks. Yet the bond market is significantly larger, and it quietly sets the financial conditions for almost everything around us, including your mortgage, including your savings account, including your retirement portfolio, including the company that employs you. The bond market is like gravity. You may not think about it, you may not see it, but it's constantly influencing everything around you. And there is one rule that explains almost everything. One rule. Learn this single concept, and suddenly the bond market starts making sense. Here it is. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. The two move in opposite directions, always. At first glance, that sounds backwards. Shouldn't higher rates be good for bonds? Not necessarily. Let's walk through it together. Suppose you buy a bond today for $1,000. It pays 3% interest. That means you receive $30 every year. You feel pretty good about the investment. Then 6 months later, something changes. New bonds start paying 5%. Suddenly, investors can earn $50 per year instead of $30. Now ask yourself a simple question. If someone could buy a new bond paying $50 annually, why would they pay full price for your bond paying only $30? They wouldn't. To make your bond attractive, its price has to fall. The market adjusts until the yield becomes competitive again. Nothing about the bond itself changed. The payments didn't change, the maturity date didn't change, the borrower didn't change, only interest rates changed. Yet the value of your bond fell dramatically. This single relationship drives nearly everything we're discussing today. And it becomes especially important when we talk about mortgages. Let's meet someone I'll call Brian. Brian is doing what millions of Americans dream of doing. He's buying a home. He's found the house, he's saved for the down payment. Now he needs a mortgage. Like most people, Brian assumes the bank simply decides what mortgage rate to charge. But that's not actually what happens. Banks don't pull mortgage rates out of thin air. Instead, they look at something called the 10-year Treasury yield. Think of the 10-year Treasury as the benchmark, the foundation, the starting point. If a bank can lend money to the U.S. government and earn a certain return with virtually no default risk, why would it lend to Brian for the same rate? After all, Brian could lose his job. Brian could get sick. Brian could miss payments. The government, meanwhile, is considered one of the safest borrowers on earth. So the bank adds a premium, a little extra compensation for taking on additional risk. That's why mortgage rates generally move alongside Treasury yields. And here's where things get very real. Imagine Brian needs a $400,000 mortgage. At one interest rate, his payment might feel manageable. At a slightly higher rate, it suddenly feels uncomfortable. At an even higher rate, the house may become completely unaffordable. What's remarkable is how little the underlying interest rate has to move to create enormous consequences. A 0.5% increase sounds tiny. Most people hear 0.5% and think, that's nothing. But on a 30-year mortgage, that tiny change can cost tens of thousands of dollars. A 1% increase? Now we're talking about life-changing money. Money that could have funded retirement accounts, paid for college, covered vacations, created financial freedom. Instead, it gets redirected toward interest payments. And that's why understanding bond yields matters. Not because you're planning to become a bond trader, not because you're trying to impress people at dinner parties, but because these seemingly abstract numbers show up in your monthly budget. They affect the house you can afford, the car you can buy, the lifestyle you can maintain. And here's the part that fascinates me. Most people never connect the dots. They experience the consequences without ever understanding the cause. Mortgage payments rise. They blame the bank. But often the story began in the bond market months earlier, and mortgages are only the beginning. Let's talk about retirement. For decades, investors were given a simple piece of advice. As you get older, own fewer stocks and more bonds. It made perfect sense. Stocks offered growth. Bonds offered stability. Stocks were the engine, bonds were the shock absorbers. Together, they created balance. This philosophy became the foundation of retirement planning. Entire generations built portfolios around it, and for a very long time, it worked. Then came 2022, and suddenly millions of investors discovered something they never knew. Bonds can lose money too, a lot of money. The Federal Reserve began raising interest rates aggressively to fight inflation. Rates climbed faster than they had in decades. And remember our rule, when rates rise, bond prices fall. Investors who believed bonds were always safe suddenly opened their statements and saw losses. Significant losses, unexpected losses, painful losses. For many retirees, it felt like the financial equivalent of discovering that your seatbelt wasn't attached during a collision. The part of the portfolio that was supposed to provide stability was declining alongside stocks. People who had spent years believing bonds were the safe corner of their portfolio suddenly found themselves asking difficult questions. Questions they had never considered before. Questions like, how much interest rate risk am I actually taking? How sensitive are my investments to rising rates? What exactly do I own? And perhaps most importantly, what don't I understand? Because here's the truth. Financial confidence doesn't come from knowing everything. It comes from understanding the things that matter most. And the bond market matters. It matters whether you're 30 years old buying your first home. It matters whether you're 50 years old building retirement savings. It matters whether you're 70 years old living off your investments. The bond market touches all of us, even when we don't realize it. And one concept sits at the center of that reality. It's called duration. Now, I know duration sounds technical. Stay with me. Because this may be one of the most valuable concepts you'll ever learn as an investor. Duration tells you roughly how sensitive a bond investment is to changes in interest rates. Think of it as a vulnerability score. The higher the duration, the more dramatic the price movement when rates change. And this is where many investors get surprised. Two bond funds can look almost identical. Both can hold high-quality bonds. Both can be marketed as conservative investments. Both can appear safe. Yet one may be dramatically more vulnerable to rising rates than the other. The difference often comes down to duration. And unfortunately, many investors never look at it. They look at performance, they look at yield, they look at expense ratios, but they skip the very metric that tells them how much pain they might experience if rates move higher. That's like buying a car without checking the brakes, or buying a house without looking at the foundation. It's information you need. Not because you're trying to predict the future, but because you're trying to understand the risks you're taking. And when you understand risk, you make better decisions. Not perfect decisions, better decisions. That's the goal. Not perfection, progress, awareness, confidence. The kind of confidence that comes from understanding how money really works. And once you begin understanding bonds, something interesting happens. Financial headlines stop feeling random. Mortgage rates stop feeling mysterious. Retirement account fluctuations become easier to interpret. You begin seeing the connections that were always there. The invisible machinery starts becoming visible. And that's when financial education becomes powerful. Not because it gives you certainty, but because it gives you context. And context changes everything. There is a major difference between owning an individual bond and owning a bond fund. At first glance, they seem similar. Both involve bonds. Both generate interest income. Both are often described as conservative investments. But under the surface, they behave very differently. Imagine you buy an individual Treasury bond and decide to hold it until maturity. You know exactly when you'll get your principal back. You know exactly what interest payments you'll receive along the way. And here's the important part. If interest rates rise after you buy it, the market value of your bond may fall temporarily. But if you continue holding until maturity, you'll still receive the promised payments and your principal at the end. In other words, the market may tell you your bond is worth less today, but the contract itself hasn't changed. The government still owes you the money. The interest checks still arrive. The maturity date remains the same. For patient investors, temporary price fluctuations often become background noise. Bond funds operate differently. A bond fund is constantly buying and selling bonds. New bonds enter, old bonds leave. The portfolio never reaches a final maturity date. Because of that, price changes show up immediately and permanently in the fund's net asset value. When rates rise sharply, bond funds can experience substantial declines. And unlike an individual bond approaching maturity, there isn't a specific date when everything automatically resets. This doesn't make bond funds bad. Far from it. Bond funds offer diversification, convenience, liquidity, and professional management. But understanding the distinction matters because surprises in investing are rarely pleasant. And 2022 was full of surprises. Many investors learned for the first time that safe doesn't mean can't lose value. Safe means different things in different contexts. Government bonds are considered safe because default risk is extremely low. It doesn't mean prices can't fluctuate. It doesn't mean statements can't show losses. It doesn't mean volatility disappears. The lesson wasn't that bonds failed. The lesson was that many investors misunderstood what kind of safety they were actually buying. And honestly, that's understandable. The financial industry often reduces complex topics into simple slogans. Stocks for growth, bonds for safety. Simple messages are easier to sell. But real investing is rarely that simple. And the more money you have at stake, the more important nuance becomes. Let's talk about another area where bonds quietly reveal information long before headlines do: the economy. One of the reasons professional investors pay so much attention to bonds is that the bond market tends to be extraordinarily sensitive to future risks. Bond investors are constantly asking difficult questions. Will economic growth slow? Will inflation rise? Will companies struggle? Will consumers pull back spending? Will unemployment increase? The answers to those questions often show up in bond prices before they appear in economic reports. Think about corporate bonds. When companies borrow money, investors demand compensation for the possibility that something could go wrong. A corporation can fail. A corporation can miss payments. A corporation can go bankrupt. Because of that risk, corporate bonds typically offer higher yields than Treasury bonds. The difference between those yields is called a spread, and that spread tells a story. When investors feel optimistic, spreads stay relatively narrow. People believe companies are healthy. They believe defaults will remain low. They believe growth will continue. But when fear starts creeping into the system, spreads widen. Investors demand more compensation, more protection, more reward for taking risk. It's almost like the bond market develops anxiety before the rest of the economy notices something is wrong. And history shows that bond investors are often paying attention to signals others miss. This is why professional money managers watch credit markets so closely. Not because they have crystal balls, not because they can predict every recession, but because credit markets frequently reveal stress before it becomes visible elsewhere. And then there is another fascinating phenomenon. It's called the flight to quality. Whenever uncertainty suddenly spikes, investors tend to seek safety. Think about major crises, financial panics, unexpected geopolitical events, banking scares, periods of extreme uncertainty. In those moments, investors often sell riskier assets and move money into U.S. Treasury securities. The result? Treasury prices rise, Treasury yields fall, sometimes very quickly. It's one of the clearest demonstrations of human psychology in financial markets. People crave certainty when uncertainty grows. And few assets offer more perceived certainty than U.S. government debt. That's one reason bonds and stocks often move in opposite directions. Historically, when stocks struggled, bonds frequently provided support. That relationship helped countless retirement portfolios weather storms. It wasn't perfect, nothing in investing is, but it provided balance. The challenge arises when both asset classes face the same threat simultaneously. And that's exactly what happened when inflation surged and interest rates climbed rapidly. The very force hurting bonds was also creating pressure on stocks. The diversification benefit weakened. The traditional relationship broke down. And investors received an important reminder. Diversification reduces risk. It doesn't eliminate risk. There is a difference, a crucial difference. One of the healthiest habits investors can develop is learning to accept uncertainty rather than trying to eliminate it, because uncertainty never disappears. Markets change, economies evolve, interest rates rise and fall, inflation comes and goes. The goal isn't creating a portfolio immune to every possible outcome. The goal is building a portfolio resilient enough to survive multiple outcomes. That's a very different mindset. It's less about prediction, more about preparation. Less about certainty, more about flexibility. And frankly, that's a mindset that extends far beyond investing. Now let's shift to something that affects stock investors directly: the relationship between bonds and stocks. Many people think of these markets as completely separate worlds. They aren't. They're deeply connected. Imagine you're an investor deciding where to put your money. You have two choices. You can buy government bonds that offer a guaranteed return, or you can buy stocks that offer uncertain future returns. The decision isn't made in isolation. Investors constantly compare the two. If Treasury bonds are yielding very little, stocks become more attractive. Investors are willing to accept greater risk because the alternative isn't offering much income. This was a major feature of the years following the financial crisis. Interest rates stayed extraordinarily low. Bond yields remained subdued. As a result, stocks looked increasingly attractive. Money flowed into equities. Valuations expanded. The long bull market gained momentum. But when bond yields rise, the calculation changes. Suddenly, investors can earn more income with less risk. The competition between stocks and bonds intensifies. Money begins evaluating opportunities differently. This doesn't automatically mean stocks fall. Markets are more complex than that. But higher yields unquestionably influence investor behavior. And that influence can ripple through every corner of the financial system. This is why the bond market often acts as the foundation upon which other asset prices are built. It provides the baseline, the reference point, the measuring stick against which countless investment decisions are made. And perhaps nowhere is the predictive power of the bond market more famous than in something called the yield curve. If you've heard the phrase before and immediately tuned out, I understand. The name sounds technical, but the idea is surprisingly intuitive. Imagine lining up Treasury securities from shortest maturity to longest maturity. 3 months, 1 year, 2 years, 5 years, 10 years, 30 years. Then you plot their yields on a chart. That's the yield curve. Most of the time, the curve slopes upward. Longer-term bonds pay more than shorter-term bonds. That makes sense. If you're lending money for 30 years, you'd expect greater compensation than if you're lending it for 3 months. More time means more uncertainty. More uncertainty usually means higher yields. Simple. But occasionally something unusual happens. Short-term rates rise above long-term rates. The curve inverts. And when that happens, investors pay attention. Because an inverted yield curve has historically been one of the most reliable recession indicators ever observed. Think about what the market is saying. Investors believe rates will be lower in the future than they are today. Why would that happen? Often because they expect economic weakness. They expect slowing growth. They expect the Federal Reserve may eventually need to cut rates. In essence, the bond market is expressing concern about the future. And historically, those concerns have frequently proven justified. That doesn't mean every inversion immediately produces a recession. Timing is never that precise. But the track record has been remarkable. For decades, economists, investors, and policymakers have watched the yield curve because it captures collective expectations from millions of market participants. No single expert, no television personality, no economist with a fancy title, millions of investors making real decisions with real money. That's powerful. And it's one more example of why understanding bonds isn't merely an academic exercise. It's understanding the language financial markets use to communicate. Once you learn that language, headlines start making more sense. Economic developments become easier to interpret. And your financial decisions become more informed. Not because you suddenly know the future, but because you better understand the forces shaping it. And surprisingly, it has nothing to do with becoming a sophisticated investor. It has everything to do with being a smarter saver. Because while most people focus on growing wealth, many quietly lose wealth without realizing it. Not through bad investments, not through market crashes, not through scams, but through neglect. Money sits in places that simply aren't working hard enough. Let's go back to Brian. We've already seen how the bond market affects his mortgage, but let's imagine something else. Suppose Brian has $50,000 sitting in a traditional savings account at a large bank. He's proud of the fact that he has emergency savings, and he should be. Having cash reserves is one of the healthiest financial habits anyone can develop. But here's the question. What is that money actually earning? Many Americans never ask. They assume cash is cash. A savings account is a savings account, and that's where opportunity quietly disappears. The difference between earning a fraction of a percent and earning several percentage points may not sound dramatic, but over time, those differences compound, year after year, month after month, without requiring additional risk, without requiring stock market expertise, without requiring perfect timing, simply because you placed your money in a more efficient vehicle. And that's one of the great ironies of personal finance. Sometimes the biggest improvements come from the simplest adjustments. Not chasing the next hot investment, not finding a magical stock, not predicting the next market crash, just paying attention. The bond market rewards attention, it rewards understanding, and most importantly, it rewards curiosity. The people who benefit most financially aren't always the smartest people in the room. They're often the people willing to ask one extra question, one more question than everyone else. Where is my money? What is it earning? Why is it earning that? Could it be working harder? Those questions sound basic, yet they're surprisingly powerful. Because wealth isn't built through a handful of dramatic decisions. It's usually built through hundreds of small decisions made consistently over time. And understanding interest rates helps improve many of those decisions. Let's talk briefly about inflation. Because inflation is one of the silent forces that bond investors constantly monitor. Most people think of inflation as higher grocery bills, higher utility costs, more expensive vacations. But investors think about inflation differently. They think about purchasing power. Because earning 4% while inflation runs at 5% isn't actually progress. You're moving backward. Your account balance may be growing, but your purchasing power is shrinking. That's why inflation-adjusted returns matter. It's why real returns matter. If you'd like to run these numbers yourself, whether it's your mortgage, your savings, or your bond investments, we've created tools that make the calculations simple and practical. Instead of guessing how interest rate changes affect your financial life, you can see the impact in actual dollars and cents. Those resources are available inside our calculator vault, along with a community of people who enjoy learning how money really works and who believe financial confidence starts with understanding the numbers. If this conversation helped connect some dots for you today, consider supporting the channel with a like. And if you're interested in continuing to learn how the hidden mechanics of money affect your everyday life, make sure you're subscribed. Because the more you understand, the more empowered you become. And that's always a worthwhile investment. Thank you so much for spending this time with me. I'll see you in the next video.